Well, we'll go ahead and get started. My name is Adam Goodman. I'm an independent advisor here in the Las Vegas area. I've lived here over 20 years. Thrilled to be back here. We were a speaker here last year as well. Got a lot of great information. I think it's important information to cover and share with you guys. It's been a challenging year in the world, in the financial markets, and I think, hopefully, you get some answers today, but the most important thing is that you realize what are the appropriate questions for you to answer, if you're working with an advisor, to get clear on the answers. And a lot of time the answers are different for each person based on your timeline, your risk tolerance, a whole bunch of other factors. But I do have this image, and I think this is appropriate, right? You may say, well, what does a mountain and snow and rock climbing have to do with finances and retirement planning? And I think for a lot of people, it's a journey of life, right? And the path can be very perilous. It could be an unknown path as you're transitioning from the working years to the retirement years. A lot of people that are already retired tell me things like, oh, I already got that taken care of, right? And I hope you're right, but I would say for the most part, there may be adjustments that make sense, right? As your life changes, as the world around you changes, the things that made sense maybe 2, 3, 5 years ago may not make as much sense now. There may be a better way to protect, to navigate, to minimize risk. So we'll talk a lot about that as we go along. As I mentioned, I'm an independent advisor. I have a bunch of other educational designations, letters on my name that I've accumulated over the years. I think the simplest way to communicate our areas where we focus on and try to deliver value for the people we work with individually is wealth optimization and protection strategists. So really understanding what is the goal, where are we at, what are we trying to achieve, what are the resources, and put together a plan, a strategy, multiple strategies, and make adjustments along the way as the individual's life and the world around us change. As I mentioned, lived in Vegas over 20 years, been doing this for over 12 years. We do a lot of presentations like this, although most of them are more private for different retirement communities, associations. Thrilled to be able to do this for the Review Journal for everyone that wants to come out. I think awareness is the first step to making better financial decisions, and I applaud everyone for taking the time to take that first step, right? For a lot of people, I know finances can be confusing, overwhelming, things that maybe you're not that familiar with, right? For a lot of people, I think it's worth getting familiar with it, right? Try to increase their understanding, right? And a lot of people, it comes down to having a trusted relationship with a professional, right? And we know that's not for everyone. We know that there's only a certain number of people a professional can serve appropriately. But it starts with education and awareness, right? So these are the 3 primary areas that I want you to walk away from the time to at least get some value in. So that you learn 3 different approaches that you can take to planning your retirement income. I think one of the challenges people have when they ask questions and think about this is they're looking for a specific answer. And one of the challenges is you could ask the same question to 3 different financial advisors. How should my portfolio be allocated? And you might most likely get 3 different answers. And it's not necessarily that any of those answers are wrong. I would suggest that very likely that one of those answers is better for you than the other answers. And that may come down to multiple factors as far as why you're getting the specific answers and the different answers. Hopefully, what I just said will make more sense as we go through. Share with you a couple strategies for navigating stock market volatility that in my experience, most people are not as familiar with as they should be. And then understanding some of those nuances and differences, different companies, different advisors, and different approaches to managing investments. Before we jump in, compliance makes us have this up. Educational in nature, what we're talking about today. Before making any choices, always recommended to talk to a licensed professional. Oftentimes the right choice for one person is not always the right choice for someone else. We're all different desires, resources, tolerances. That makes sense, right? So retirement income plan, what is that? How I think about it is it's really about a distribution plan, right? And so we'll talk about the money cycle. most people are familiar during the working years. We call that the accumulation phase, right? You're not really relying on your savings for distribution. You're not relying on it for income. You're not planning on taking it out. So one of the questions an advisor might ask you is, how long do you plan to continue working? When do you need to start drawing on this money, right? That's an important before making any specific recommendations. The strategy, most important thing here is the right strategies for the accumulation years, in my opinion, are vastly different in most cases for the right strategies in the distribution years. Now, the preservation years is maybe 2 to 5 years as you're transitioning from your accumulation to retirement. So in my experience, and again, I have retirement income certified professional, all the education, the most important, the biggest, most likely situation where you're not going to have your best financial future, where you're going to make a mistake, is the 3 to 5 years before or into retirement. Most likely. Now, depending on what the external factors, what the market's doing, it could change that, right? You may get lucky. I'm going to share with you a couple slides. Obviously, we know that none of us want to be on the unlucky side of what we call sequence of return risk or order of return risk. Have any of you ever heard those terms? The sequence of returns? No one, right? So that's pretty standard. It's generally about 95 to 99% of people haven't, right? And so you're going to know about that before you leave today, and it's crucial. And I think that will make more sense as you think about the money cycle, right? So on the left side here, we have what we call the old way. There are many people, maybe your parents, they worked for a company for 30 years, a pension. Pension is income for as long as you live, right? Social Security in the middle. And then 401k or your savings, the nest egg on top. What you'll notice is typically your responsibility is the smallest part of that, right? We're not going to be able to get into pension issues today, pretty well documented, right? There are still people that have them. We don't recommend on relying on any one of these three, we call them like buckets or areas of your income plan, right? But quite often moving forward, a lot less people have pensions, right? Companies realize how expensive they are, and really they started shifting from pensions to what's called defined contribution. Most people know it as 401k. Say, hey, it's your responsibility to determine how much you're going to save. And quite often they're going to give you some incentives, a match, right? But there are people that don't have those plans. There are some people that have those plans, but the match is not that much, limited. It may not be enough. But the main thing, even if you do have some great help building your nest egg, the thing is that your nest egg is typically the largest portion of your retirement plan. So you need to figure out how you're going to grow it, protect it, distribute it to and through retirement. And that's another reason we have that mountain image, right? There's a lot of people, hey, well, my goal is to get to retirement, right? And it's very, very simple in most cases. Not always easy, and we don't always have the answer we'd like to give people, but it's a pretty simple calculation, right? If I'm talking to someone who's 55 and they say, hey, I'd like to retire at 60, 62, whatever that number is. Here's my assets now. Here's my income need. We can run some calculations, different rates of return. It's a pretty simple answer. But to answer the question for a 62-year-old or 65-year-old at that point, how much can I take out without risking running out of money? Whole different answer, whole different set of questions. Why? Your retirement, that's the top of the mountain. How many years are you going to be in your retirement journey down the mountain? Do you need that income for 20 years, 30 years, 40? The answer is going to be different for each person. Most fatalities, most accidents in real life in mountain climbing happen on the way down. People are focused. Right? I want to get to that goal, right? They train, right? And we're not going to get into it today, right? There's a lot of risk on your retirement journey, on your distribution plan, that can mess up your plan. That can make it to where, oh my God, I thought I was squared away. Oh, I didn't know about that, right? And typically, the biggest risk that you can control in retirement I would say the two biggest is stock market volatility and healthcare risk, right? Losing large amounts of money or having to spend large amounts of money in short periods of time. Right now, there could be some other things based on your family dynamics and all that. Obviously, we don't really get into politics with people too much. You know, some people are very comfortable with their Social Security income. Other people say things like, that's not going to be here, you know, type of stuff, right? Taxes. If taxes go up in the future, many people are concerned with that. So you could have a plan, but you may want to stress test the plan for a couple different worst case scenarios or negative things happening along the way, right? And for married people, it's even more of a challenge because there's 3 scenarios you have to plan for. One is, how do things look for both of us through retirement, right? How does it look like in a worst case, right? For a surviving spouse. How does it look like for her if he passes first? How does it look like for him if she passes, right? So if a spouse passes away prematurely, right? We're planning for 20, 30 years. Well, typically what happens in that scenario is income goes down and taxes go up. Expenses go down typically, but not proportionally, right? Stock market investment consideration. So before I jump into that, so on your note sheet, in my opinion, right, I have this little so you can be engaged, right, a little bit, right? In my opinion, one of the biggest challenges to address in a blank plan, so in a retirement income plan or a distribution plan, so that's what you're supposed to write in there, is sequence of return risk or the order of returns. And we'll have, I think the slide's coming up, 2 slides. So stock market, people are familiar with, it fluctuates, right? The economy fluctuates. It's cyclical in nature. I think a lot of people get confused. They're looking for a specific answer. If you watch too much of CNBC, you might come to that conclusion, right? It's like they're telling us why it happened after it happened, right? But ultimately, markets move based on supply and demand, buyers and sellers. And it's really interesting if you think about stocks, because it's quite a bit different than a lot of other things in life, right? If you think about, you know, hey, this pair of shoes costs $100. It's on sale for $70. Cool. Let me get 2 of those, right? Hey, your favorite stock is $100 last month and now it's 70. People typically aren't cool. Let me buy twice as much, right? They're kind of wondering, what's going to happen here? Is this thing going to go to zero? You know, things like that. Diversification, important, but a lot of people get that wrong. Share a little bit about that. If you are looking at individual stocks, a lot of people do-it-yourselfers tend to do that. Not only are you having to deal with the first 3 risks, but now you also have to deal with not just market risk in the economy, but sector risk. So what does that mean? Well, if you're investing in semiconductors, now you may have to deal with whatever China and Taiwan are dealing with, right? Or supply chain. So you have market risk, you have sector risk, you also have company risk, right? CEO leave, CFO, all this stuff. So now you have that logical, but is money always logical? Money can be very emotional, right? So again, right answers for one person, completely different, maybe just based on these factors. How are you going to respond if you lose if your investment portfolio loses 20% in a short amount of time? You should have a great answer to that question. And the answer, in most cases, is different person to person, right? So we say, hope for the best, but we want to protect against the worst, right? And there's all sorts of worse, bad things that can happen along the way. So sequence of returns, right? I asked you guys that. None of you said you're familiar with it. So we have a scenario here. Again, think about accumulation years, distribution years. So here we have the accumulation years. 10-year average return, scenario 1. Scenario 2, same average returns. Start with 100,000. The difference in these scenarios is scenario A, you have 2 large losses early, right? You see the negative 30 and the negative 20, year 1 and 2. You can see the balance go from 100K to 56, right? We talked about money being logical and emotional. This chart is logical. In my experience, 80-90% of the time in this scenario, there's going to be some emotional dynamics going in for investor A. Well, I thought, investing in my future was a good thing. This was 100,000 2 years ago. Now it's 56. Should I have done this? Was this a good decision? All those things, we understand why, right? So are they going to stay that course? In my experience, quite often the answer is too often is no, right? So this is assuming they stay that course, and you can see they end up at 154, right? So 10% rates of return in years 3 through 8, big gains in years 9 and 10, right? Now we have scenario 2. Now we have the big gains early. So now those year 9 and 10 returns happen right away, right? Years 3 through 8 are the same. And so you can see this investor is thrilled with their decisions, right? Especially in the early years. Wow, this was great. Look at that, 5 years, right? But they end up at the same place, right? You guys notice that? So we're in agreement, right? Distribution years, same 100,000, same returns, right? So now sometimes we call this Mr. Lucky, Mr. Unlucky, Mrs. Lucky, right? So on the left side, you retire, right? And this is not just fantasy, right? Think about this. Somebody retires on the left side, this is 2008, and they retire, right? This is fall of 2018, right? This could be 2000, whatever, right? We go through time, and markets do these things, right? So if you happen to retire and start taking money out, and you have those large losses early, and you're taking withdrawals because you need that for your retirement income, it's like this avalanche effect. The losses compound, there's less money in the account. So even when you do get positive returns in the overall market, there's not enough money in the account to actually make it meaningful to support the withdrawals. You guys see that? Does that make sense? Scenario 2, we have the big gains early. Still taking that same income, but now there's plenty of growth to support that withdrawal in years 3 through 8. So you could see all we did was we added a consistent withdrawal along the way. And you could see the difference in the net result. After year 10, the person on the left has less than 40,000. The person on the right still has more than they started with. I would say it's going to be your story in retirement. Everyone says, that'll be me on the right there, right? We hope. Unfortunately, if you don't have a good plan, I'm concerned that too many people are going to be on the left. But now you have awareness. You understand? And this is why the next info that I'm sharing with you is so important. Okay? So, retirement income approach 1. This is using investments, typically stocks and bonds. Most common. There's pros and cons to all of these. So there's advantages and disadvantages. So it's not like, oh, yeah, I knew that one doesn't apply, right? No, that's not true in most cases. So greatest growth income potential, most flexibility to make changes in the future, gives you, the client, the investor, the most control of your assets and the ability to make changes. So if you need a large withdrawal in any one year, if you like to make adjustments, and you'll like this the best of the three. What are the cons of this approach? Typically have the highest direct cost, especially if you're working with a professional, because you're going to have your expenses, your trading, any sort of fund fees or transaction fees, as well as an advisory fee. Least predictable of the three options for as long as how long money will last, right? Because I don't know, are you going to be Mr. Unlucky or Mr. Lucky, right? I don't know, right? We need to have a wider range of the projections. It needs to be monitored, managed on a more regular basis, right? This approach is most impacted by the sequence of return risk. So typically people are using the things on the left in this scenario: stocks, mutual funds, bonds. Those are the most common. Now you'll see on this chart, there's 3 different annuities, right? We're not going to be able to go too deep into annuities in this, but very important that you get familiar with annuities as you're approaching retirement, in retirement, and really figure out, is an annuity right for me? If so, what type of annuity? Why? So, and that'll tie in to approach number 2 and beyond. So approach number 2 is self-managed with principal guarantees, typically zero management or advisory fees. So this is a principally protected account, provides much greater predictability into how long money will last than the investment approach, right? If we have a principally protected account, there's $1 million, say, hey, we're going to take out $50,000 a year. Say, well, hey, this is going to last for at least 20 years, even without any interest or growth, right? So we want to factor in, you want to add 3%, 4%, can run it, hey, you got at least 23 years, or at least 25 years, right? Now, there's always challenges and there's always opportunities, in my opinion. And one of the benefits of what's occurred this year is rising interest rates, right? So, and maybe as stock market and bonds don't look as attractive, in many cases, options in here look more attractive than they did a year ago. So the main negative to this is typically there's going to be less liquidity or flexibility. Or when we say liquidity, we're talking about access to your money, right? So if you know, again, you need a large distribution next year, you probably don't want to put that money in something like this. But if you're like, well, hey, this is money that I don't need for 10 years, right? Then that might be appropriate. And that's where a lot of people get confused, is in a plan, typically it's going to include 3, 4 different investment strategies. I think of them as tools, right? Hammer, screwdriver, wrench. If you're a golfer, driver, 7-iron, wedge, putter, which one's better? Depends. Where are you at? What are you trying to achieve? Right? In most cases, they're all helpful in some point, in some ways, right? But you definitely don't need 3 hammers or 3 drivers, right? In golf, any golfers? Okay. So, principal guarantees, typically it works well mixing some of these strategies. So you have a certain amount in strategy 1 and a certain amount in strategy 2. And that might give you flexibility to say, hey, when the markets, when my stocks and bonds are doing well, I'll take my income from that. But when they're down, I'll take my income from my principally protected account, right? I don't want to have to sell investments after declines. I want to be able to wait and let markets recover, right? So you got to, if you're going to take that approach, you got to have at least a second place to pull from, right? So with this chart here, anything above the red line is not guaranteed. You could have losses. Typically, you'll hear things like bonds are less volatile or risky than equities. Typically true, not always true, depending, especially in a short-term scenario. But anything below the red line is a principally protected option, right? The challenge is you don't want to have too much just in checking or savings, right? It's safe, but what else is it doing for you? Typically not much, right? So again, it's that balance of risk versus growth, and the right answer typically changes for each person. Strategy number 3, dependable income for as long as you live. Quite often I talk about this as being able to create a private pension, right? We talked about how companies aren't giving, right, as many, but with certain types of annuities, you can use that to create income for as long as you live. So 2 unique guarantees of certain types of annuities. And if neither of these guarantees is of interest to you, and all guarantees on these products are based on the claim paying ability of the issuing insurance company, right? Is a guarantee for income for as long as you live, or a guarantee of principal. If you don't need either of those, you probably don't need an annuity. There could be some nuances to certain annuities with certain sort of riders and things like that. That maybe, but I would say my statement is probably, in my opinion, probably 95% plus accurate. Okay. So typically more flexible than other. So the one thing about annuities is they've changed a lot over the years, as many things have changed. Some of the things we've heard is, oh, well, if you buy an annuity, you can't get your money out, right? If you buy an annuity and you pass away, the company keeps all your money. And there are annuities that are like that. Do you want one of those? If you don't, there are other ones that are not like that, right? So main con here is less liquid and flexible. So of the three, this is going to even be the less liquid and flexible to make adjustments, right? But as you're thinking about, and I have a chart here that I think communicate this idea very well, the idea of building a foundation, building a base, right? And for most people, if they're utilizing this strategy, this is in that category, right? You think of it like a home, right? You have the foundation, the walls, the roof. Most important is make sure you don't have a foundation problem, right? A lot easier to do a repair on the roof than it is a foundation. Again, often works quite well with one or both of strategies 1 and 2. And so it's important to understand, right? Because a lot of people have specific opinions about, strategy, stocks and bonds are great, annuities are terrible, or vice versa. And I don't share those. They're all pros and cons. They're all tools, right? The way I think about it, so here we have an old school landline phone, right? And on the right we have, right, mobile phone, text, internet, all that stuff, right? If all you want to do is call someone and talk to someone, they can both do that, right? But if there are some other features that are important to you, the one on the right can do things that the one on the left can't, right? There are still some people in the financial service world, financial advisors and individuals, in my opinion, that are utilizing strategies and approaches, what I would say is like the landline phone, right? Probably not the best. It may work okay if all you need is that, right? But as you can see, we're dealing with a lot of risk, a lot of uncertainty. A lot of times you need better tools, better options, more other things, right? So it's important to understand. Again, I share with you, you may ask the same question and get 3 different answers from an advisor. Well, typically it comes down to 2 things in my experience. One, the type of company that they work for and their licensing, and that typically comes down to how they're trained. And then it often comes down to their own level of knowledge and education and learning, right? I mean, some people are smarter than other people, right? In everything in life, right? I'm not going to say this is rocket science, but when you're trying to analyze data and there's a lot of uncertainties and you're trying to predict most likely outcomes and it helps to have someone with a little bit more, than just regurgitating what they heard, but they can't really explain why they're coming up with that, right, based on logics and facts. So on the left side, you may hear things like Series 6, Series 7, there's a broker. On the right side, Series 65, RIA. How many of you have heard the word fiduciary? Who can tell me what it is? Okay, I won't put you on the spot. Okay. So a fiduciary is someone that has to do what's in the client's best interest first, right? That comes above everything else. Whereas a broker, they're not held to that standard. You just have to make sure that what they're recommending is what's called suitable or appropriate, right? And one of the challenges, as you'll see on this next slide, is there are different financial products, just like I said, right? Different financial tools, right? Hammer, screwdriver, wrench, driver, 7-iron, right? So it also comes down to, obviously, if you're working with a professional, you want to have a comfortable relationship. You want to have a lot of confidence in their knowledge, their integrity, understand, feel comfortable with their process, right? So there's always going to be conflicts of interest. So it's up to how is that professional going to navigate that? How are they going to communicate that, right? I would say that there's more of those conflicts in the broker world, right? Because you can see here we have 7 different financial products. Typically, those are going to be, if you purchase one of those or if they sell you one, typically they're going to get compensated for that. Some of the compensation is upfront. Some of it is ongoing, a little bit every year, as long as you keep it, right? One of the challenges is if the compensation is upfront, right? If a mutual fund paid, for example, 2% compensation to them and the REIT paid them 4%, they may have a conflict in which one should I recommend for my client, right? Now, it may be that the REIT is the best solution for that client for specific purposes. and the representative makes more money. Cool, win-win for everyone. But the challenge is if the higher commission product is not the best solution for the client, right? So investing versus planning, if you talk to someone and they're like, hey, we got this great investment, let me show you how it works, this is cool, right? Probably more focused on a broker, probably more focused on just getting the account open, right? Planning involves getting the data, gathering it, analyzing it, right? We have a lot more information we can share with you beyond today. We have our booth. I have some information there. We have a YouTube channel. I post a lot more stuff. So if any of this resonates with you, you want to engage with me further beyond today, a lot more sort of down that rabbit hole. But we don't have time to go there as far as the planning side. But what I've learned over the years is that when you do the proper planning, it makes it so much easier to do the right investment management because we know why we're selecting this option and not that option. Does that make sense? I think that's so important that you understand that. Because if you are going out and having a conversation and sitting down with different advisors, what is their process, right? If their process starts more with their product or what their company does, you should get a feel that, hey, this is probably someone that emphasizes that a little bit more than that, right? So we're going to talk a little bit about stocks and bonds. Kind of, think about the phone, right? Old way, new way, right? For a long period of time, bonds did a great job within a portfolio in a declining interest rate environment. Are we in a declining interest rate environment anymore? May not be the best tool anymore. Cool. Glad it worked for you 20 years ago. Doesn't mean it's the right tool to work for the next 20 years. Doesn't mean you can't use it though, but maybe you don't want to rely on it as much, right? So a common way of managing money or coming up with a recommendation is 60-40 portfolios, 60% stocks, 40% bonds. More comfortable you are with risk, maybe a little bit higher on the stocks, 70%, a little bit lower on the bonds. More conservative you want to be, maybe we're going to go 40% stocks, 60% bonds, right? So standard approach to constructing a portfolio, making portfolio changes, right? So what do you see here with growth? I highlighted a couple things here. So now a lot of people, especially in retirement, they want to reduce potential volatility, right? They don't like seeing big fluctuations month to month, year to year with their investments, right? Should I buy bonds because of that? Because I want to reduce volatility? Maybe. I'm going to say, I don't think that's a good enough reason to do it. There should be some other benefits to it because we know there are other financial tools that will reduce volatility, right? I shared them with you on that chart, right? So if that's the goal, we should analyze all those different tools to try to figure out which ones are best or not for us and what degree. If you're working with a broker, if you're working with someone who's only focused on investment markets, they may not be knowledgeable about those tools. They may not be able to provide those tools, right? So growth, equities, high risk tolerance, long time horizon. Does that sound like retirement? Does that sound like the distribution years? Maybe for you. I can tell you, I would say 90+% of the people I talk to, that's not them. They might have some of their money where they're okay with that, right? But that's not what they want for all of it, right? Or the majority of it. Again, landline, iPhone, or Droid, if you're like me, I have a Droid. So let's talk about some of recent returns. So these are U.S. sector returns for the second quarter. So figure 5. You can see here, again, we talked about things are cyclical, right? Typically just because, so people, again, you spend too much time on CNBC, you get like part of the story, right? Just because certain stocks are going down or certain sectors, other sectors are doing good. Typically, doesn't always work, but typically, right, they call them what's the defensive. So typically healthcare, utilities, energy, right? And you can see there, those are some of the better performing sectors. Commodities, right? We all have experienced higher cost of food, higher cost of gas. So if you had more money over there, you didn't do as bad as someone who was more of a growth-focused investor, technology, communication services, right? This next chart I think is even more important. So this is year-to-date returns through June, through the first half of the year. And markets have moved quickly in the last 3 months. June was one of the worst months, right? And the last 30 days or so have been amazing, right? Quite a bit more so than most people experience. And I would say, unfortunately, in my experience of following the market pretty closely for the last, 5-6 years, pretty closely, been doing it, following the market much more than that, but I'm saying like almost daily now, is it typically moves much more than we expect in both directions, right? And so, but the interesting thing here is, let's look at that fixed income, right? Right here and right here, right? Bonds, right? Again, traditionally, if you use bonds, it's to reduce volatility, right? Typically, bonds are supposed to do better when equities aren't doing that well, right? Hadn't been the case this year, right? Is one of the work, right? I think there's plenty of reasons to understand that makes sense, right? Interest rates have been going up. Bonds don't do well for existing bondholders. You could see how high interest rates have increased, right? Very large changes. It might not sound like a lot to go from 1% to 3%, but percentage-wise, that's a huge change, right? So we'll talk about the idea of, sometimes people say, I want some gold. That will, diversify, right? Right? It's defensive, it'll do better. Oh, it didn't do as bad, but it didn't do well, right? And that's one of the challenges, is an old way of diversifying, in my experience, quite often, or in many cases recently, hasn't produced the results people thought or hoped for. And I think it's reasonable to think that may continue to be the case, that trend. And that's why I think it's so important to at least become familiar with some of these other options that, in my opinion, do provide a much more predictable path, higher probability of success. So here we have 14 different financial options, right? Most people are familiar with stock, individual stocks, stock bond fund. Again, think of that house, foundation, wall, roof. Interesting thing is most of your stocks and bonds here, right? Especially if they're individual, they're all in the middle or the top, right? What do you have in the bottom? What do you have as your foundation? Good question. You should have a good answer. Your advisor should have a good answer, right? Again, you'll notice that they're typically not investments, right? Some combination of insurance, bank products. So learning about financial options that can provide flexibility, growth, varying levels of downside protection. How many of you are familiar with structured notes? One, about 20. Congratulations, you're ahead of the percentages. Quite often it's not surprising if it's none. But you're all going to know a little bit more about it, right? Very important. I've been using them for about 6 years. And we have different strategies we call with our defined risk, right? So you can change the risk reward. So typically in the investment world, it's that red line. You have unlimited upside. Unfortunately, that comes with what? Unlimited downside. So what is defined risk? It's changing that risk return outlook, that risk return scenario. So here's an example of a structured note where typically there's always a trade-off. Again, it's not a perfect product, but now that blue line, you're limited to the growth. You're not going to make more than that. So if that's right for you, you need to be okay with understanding, hey, if things are great, I'm not going to go up as much, right? But if the markets are down, I'll go down less. Depending on the structure or the term, you may even make money when the markets are going down. How cool would that be? How many of you know how to do that? You will after this, if you take good notes. So, what are structured notes? It's a sophisticated investment instrument. It's typically only offered through advisors, issued by investment banks. Not right for everyone. All different sort of structures and reasons, but typically it's for income or for growth. And here's an example. And so I've been using these for over 6 years, and what got me into it is the idea of not having to rely on the market to continue to go up to make good progress each year. Number one. Number two, how cool would it be to earn 6, 7, 8% even when the market's down 15 or 20%? Well, a certain type of note can deliver that for you. So what you'll see here is down market, but again, there's no free lunch, so these aren't risk-free. Most of the notes that I see as the most attractive, you're protected down to a 30% decline. So if the indexes go down to a 70% level, you're going to have a potential substantial loss. So for some people, this isn't right. But I always say, another good question, people say, that's too risky, or that's not good. Like, compared to what? What are you doing now? How do we know, right? So again, what would be a really great scenario is you have it go down, but it doesn't go down below that 70%. And so these products have really benefited this year from an increased interest rates, increased interest rate environment, and they also benefit from when stock market volatility goes up. So really cool, like people don't like, it's not fun when the market goes down, but for new money, it typically is much more attractive. You could see here, this is the average interest rate on the notes that we use every month or used. And, from in 2021, the average a little bit less than 8%. You could see it ticked up in February this year, ticked up over 11%, right? So again, they benefit from rising rates and they benefit from market volatility. Do stocks benefit from those two things, typically? Interesting. Might be a good diversifier to mix in, to have for a portion, right? So what do I think makes sense for most people? Something that looks like this. So the blue side is that equity for your unlimited growth. The orange, some combination of structured notes, right? And the pink is your principally protected strategies. Think of foundation, walls, roof, right? Now we can adjust these. Some people will have bigger slices, of course. Smaller, some people might have another slice or two. But everything I'm showing you here are different financial tools that I've used over the years. I'm not using all of them these days, right? Different environments, different times, different levels of attractiveness. So as we're wrapping up, we're doing pretty good. I can go on, and I'll be happy to do that until they kick us out. The next one comes along. I would like to be able to take a little bit of Q&A with you guys. So this is our planning, a very simplified approach. We have a simplified approach and a more comprehensive approach. Like some people, you don't need a gazillion meetings and 50 questions, but some cases there's a lot more to it, right? So we have a simplified approach and a more comprehensive approach. In this scenario, we're really looking at three things. When do you need the money, right? Now, soon, later. What is your personal risk tolerance, right? Are you moderate conservative? Are you aggressive, right? We're going to use different tools. The now bucket is simple. The later bucket, pretty easy too. The magic is that soon bucket, right? Because if you're going to draw from it, you don't want to take big losses, but you also don't want zero gain, right? So I said the two. The third is what's the objective, right? Is it an income strategy? Is it a growth strategy? Is it legacy? Thank you very much. Question?
On your, we've got a fan back there.
Couple.
On your complementary investment strategy session, what is the result? What's the takeaway?
Everybody's different, right? But again, it's being able to give a little bit more answers to the appropriate questions for that person. And a little bit more better understanding of maybe some of the pros and cons of things that they're doing now, maybe some things that they could be doing to make some improvements.
Will that be in the form of a written report or just someone saying, oh, here's what we think, or?
It's customized. So, typically for a complimentary session, it's more of just a verbal, maybe a summary. We do offer much more in depth, and we can offer that and discuss that, what sort of fees that might be. Thank you for watching. I hope you found the information helpful. If you'd like to talk about potentially having me as your advisor, use the link below or visit our website to request a no-cost, no-obligation conversation.